Hello viewers and welcome back to Dukascopy TV. I'm Ben Jones and alongside me today is Anton Ratchinski, an investment advisor from CBH Bank Geneva. Anton, thank you very much for coming in today.
Hi Ben, thanks for having me.
Anton, if you could begin by talking about the recent increase in return from high dividend strategies. Why is there more focus here and what are the pros and cons of this?
Yeah, I would actually talk about an increase in interest in high dividend strategies rather than the increase in return per se. Because if you look at year-to-date returns of dividend indices versus the usual equity indices, they're pretty much the same. Now, obviously, investors have been increasingly become interested in these type of investments because the yields on quality investment-grade paper are so low these days that people actually have to look for alternatives, and they've turned to high dividend stocks. But the thing you have to remember is that a dividend stock and a yielding bond of say the same issuer, to keep it simple, are plainly not the same thing. Meaning that the volatility, if you look at the volatility on average on stocks versus bonds of the same names, you would see that the stock volatility is about 3 times higher on average than the one of bonds. So you really have to measure the, as always, the risk and return in these cases, and look at company cash flows, the quality of the balance sheet, rather than just the absolute size of the dividend rate when selecting these types of stocks. So high-yielding dividend stocks cannot really be considered as a valid alternative to investment-grade bonds. They could be considered as an alternative to high-yielding bonds within the global allocation. But just as I said, it's just not the same thing.
Okay, now moving on to European equities. How have they fared recently, especially with regards to the ECB rate cut?
Well, European equities from the beginning of the year have trailed, obviously, US returns by about 10%. And looking at the recent ECB rate cut, you can see that the Euro stocks or the DAX index have not reacted that vigorously to this. I mean, starting from November 7th, which was when the recent rate cut was announced, we're negative on most European indices. I mean, at this point. Therefore, there has not been such a big boost from the announcement. However, everyone is expecting at some point early next year for the ECB to begin a second phase of its LTRO program, and that could have a decent effect, especially on financial stocks in Europe.
Okay, and finally, looking ahead into 2014, where do you see as the key areas for asset allocation, and are there any areas that you would advise caution for?
Well, definitely, even as a balanced investor, you have to have a foot in equities in the coming year. We've seen how equities have dramatically overperformed investment-grade bonds in 2013. And with the growth numbers sort of getting on a decent positive slope, as I said, you need to consider equities as a part of your portfolio. We are quite cautious on gold, and we're not alone here. Our logic being that with the monetary stimulus in the US being starting to be withdrawn from the system, gold lacks the support it had during the past couple of years. In terms of fixed income, we would be quite cautious on investment grade and government bonds in general. We expect yields to gradually rise throughout 2014, but there are some interesting stories in high yield, notably European high yield, that's thoroughly investable through funds or individual names, and also some individual emerging market high yield stories that are definitely worth looking at.
Okay, Anton, thank you very much for coming in and talking to us today.
Thanks, Ben.
And thank you, viewers, for watching. Make sure you stay tuned to Dukascopy TV for more updates and exclusive interviews. But for now, goodbye.